was asked really to talk to you in relation to, where there might be areas where we could collaborate, between auctioneers, solicitors, accountants. We're dealing with farmers on a daily basis. We don't have all the answers, and you can be a very valuable source of expertise. And at the end of the day, we are all aiming to ensure that the farmer is left in a stronger, more viable position when we're finished dealing with them. I mean, that should be our primary goal. And we are in an era where there's extreme volatility with regard to output and input prices. There's a constant, farms are different to a business. The business decisions, in big business are taken at the board level. In a lot of cases on farms, there's a conflict, there's a contest for cash between the farm family and the farm business. So that, their decisions are not taken solely on the basis of free availability of cash. And particularly in the sector I deal with, the livestock sector, the non-dairy sector, the issues that arise there on a daily basis are very, very different to maybe a lot of the stuff that's been spoken about earlier on in relation to tax. Wouldn't be the number one issue, because you need to have a reasonably good, strong level of income for to be constantly worried about tax. So I'm coming at it maybe from a slightly different angle. I suppose first of all, to maybe introduce the sort of area and that I deal with, the type of clients I deal with, and that may help you looking at that and see from your point of view where there's areas of collaboration, and I will tease through some ideas where I think we can all collaborate to make the farmers' lot a better situation. Where do I work? I work in County Kildare it's a utilisable agricultural area of around 115,000 hectares, dealing with 210 contracted clients. I think if we talk about the heading on the paper, working with farmer clients, that also includes non-contracted clients. We in Teagasc, we're publicly funded, so we also deal with maybe a similar number in groups or at public events of non-contracted clients. So that's just of the clients on the books, my individual book at the moment. What type of farm? They're predominantly, livestock farms, non-dairy livestock farms, beef farms, with 50% of them with operating breeding herds and 50% trading. So you can see straight away there is no average farmer. There are two different distinct beef systems. There's also some in sheep. It's not as homogeneous as a dairy operation. Average farm size is large by the national statistics. On average, the size of farm on my client's farm is 68 hectares, with the national average about 33. That reflects more the area of the country geographically I work in rather than anything else. And the big thing, I suppose, about, to look at it, even at that scale of farm size, it's 50% of them, of the actual operators, agriculture is their primary source of income, and 50% of the farmers themselves operating the business have an off-farm income. And 75% of the households have a non-farm income. So there's only 25% of the households solely dependent on agriculture. So at the end of the day, why are people farming? They're farming to make money. Why are we working? We might like what we do and love what we do, but we even like even more so the day we get paid. So maybe looking at it from the point of view of what sort of money is available on farms, because that limits to a fair extent what you can do with people or what opportunities they can avail of if there isn't sufficient cash available. And Jim Power mentioned, I think, first thing this morning, volatility of farm income. Farm incomes are very volatile. They're dependent on input prices and output prices, and a lot of those issues and costs the farmer doesn't have any direct control over. So we come in relation to looking at the other aspects that make up farm income and to see how can we improve the situation there. If you look at it, even 2012 family farm income as measured by the Teagasc National Farm Management Survey declined by 15%. And again, a lot of that was weather related. That's across all farm businesses, all enterprises. So there was a 15% drop. And obviously the livestock sector suffered a greater hit there because they had a greater dependency on grass-based systems. Farm system is the main drivers of variation within agriculture, in the sense that dairy farming is an awful lot more profitable than the livestock, the non-dairy sector. And indeed, if we look at, going back to what Andy McGarrigle mentioned there this morning, where we all sat up and listened and very attentively, and despite, not just because Andy is a lovely speaker and he presents it very well, we were very, very interested in what he had to say, because the amount of money he's talking about on dry stock farms, the direct payments last year on both of the beef systems, the trading systems and the breeding systems, the payments from Brussels accounted for 20% of farm income. And the specific premia Andy spoke about comprise 80% of farm income. So the dry stock sector have two distinct sources of income. They're what they sell, their output, and particularly the direct payments, and they're in decline. So to tease that out, I said I'd have a look at what comprised farm income in 2012. Gross output in 12 was €82,450, so it was up 0.3%, the change over 11. Of that, direct payments accounted for 25% of the value of gross output. So a very significant part of the total farm income, and that was a decline of 1% on the previous year. So the general pattern that has developed over the last 10 years is the gradual decline in single farm payment and direct payments, and our purpose really within Teagasc is to try and move people away from that massive level of dependency in the dry stock sector to as great extent as we can on direct payments funding the farm. The other thing that the farmer has no great control over are production costs. To a certain extent, we can mitigate those by increasing output and diluting down costs, and that's part of the programme. Production costs were up 9% in 2012 over 11, of which the direct costs, which is the feeds, the fertilisers and all of those, were up 14%, reflecting the inability to produce sufficient feed on the farms, so it had to be purchased in, and grain prices were much higher. Overhead costs went up about 4%, and there's an inexorable rise there. Overhead costs are continually going up and going up all the time, and then when you get issues of weather-related issues or supplies, then the direct costs can be very volatile over a short period of time, so it makes it very difficult to plan financially on farms. And family farm income was 25,479 odd, so there was a 15% drop there. And as I said earlier, direct payments as a percentage of family farm income, 81%. So again, that's one of the areas that will need attention, and why it's very important that we get a conclusion and clarity in relation to single payment. So how do we deliver the dry stock advisory programme, and are there areas where we can collaborate and provide a better service for our clients, and maybe make the delivery of our own role and programmes a lot more efficient? So really we're after is an increased, in my particular situation, to increase the profitability in livestock farms. A good active livestock sector, and the non-dairy livestock sector comprise most of the farms in the country. So it might have the lowest form of income, but they are the greatest single biggest enterprise, and without a viable livestock sector, we won't, our food industry and exports, they won't be receiving the great plaudits that the raw material comes from, individual farm level, and that's essential that that's maintained. And I'll mention that later on in relation to maintaining output, the whole area that Pat Bogue spoke about in relation to moving the productive assets. When we talk about land being moved or whatever, there's an asset being moved, but there's also an income generating unit being moved, and we want to make sure that as a result of the transfer process that you're not getting a drop in production. So what are we at? We're looking at increased output, reducing the unit cost of production to both clients and instead of non-clients, primarily through technology adoption, looking at new ideas, looking at research, getting that out onto farm level, adoption of better genetics. We can see the improvement that made in dairy situation, the improvement in genetics. That has a direct benefit to the bottom line, and the similar situation in the livestock sector. Business planning. Based on the variability and volatility of input prices, business planning is essential. And I look at maybe some ways where we can collaborate. And I suppose the biggest difficulty we have in the dry stock sector is the very little access to up-to-date financial information, very little recording going on. We were completing profit monitors there for the last 2 to 3 months, and it was difficult to get the financial figures for 2012, which is 12 months later. So, you know, we're now analysing in probably in the next couple of weeks, bringing people together to go through their profit monitor, and a complete year has passed by. So I think we can work together, particularly with the accountancy profession, to try and ensure that there's better recording of on-farm data, and maybe it will make all our lives a lot easier and end up with more timely information for farmers. Again, I said it's, you know, we are now in the area, well, since '87, where we charge fees for clients. So they're looking for a return on the fee paid. I put up a schematic diagram there of probably when you're being taught how to prepare PowerPoint presentations, you're told not to do that, but I put it up to try and illustrate the various contacts, the interactions clients have, and the amount of people. Two ways you can look at it. Some farmers will say, look at the amount of people who are feeding off us. And if they're in a positive mood, they'll say, look at the amount of people we can interact with and pick up information. So you take it as you read it. I'm looking at maybe the short-term and long-term issues. We deal, you know, with the farmers on a day-to-day basis, be it nutrition, animal nutrition, soil nutrition, and also we're looking at the long-term issues there, particularly when we come down to analysing accounts and financial information, and maybe in relation to inheritance and succession. You know, we would be dealing with farmers on an individual basis there and be teasing through the options right throughout the year. We provide an independent advice, so whatever we do for farmers, it's on an independent basis, and we don't particularly have any axe to grind at all. So we're looking out, essentially, we're not like somebody going in to sell something. If you're going into a farmer on a commercial basis and you need to sell something, the success of the business is based on the sale being concluded. The success of our visit there is in relation to you know, something being adopted or an improvement in the overall farm situation. And I thought at the top there, you know, the primary link is between the advisor and the client, but also we interact, you know, with your own professions, and possibly there is, and in a lot of cases, you know, we can improve that, and we can have a greater level of contact for the betterment of the farmer. And I'll see maybe when I describe some of the ways we delivered the service, you will recognise areas where there can be collaboration. Advisory methods, you know, in the past, the one-to-one interaction, the farm visit, the consultation, the farmer likes that. It gets an individual attention. Sometimes it's not easy to do that because it's expensive and it's time-consuming. Numbers are declining. So there's a move on to dealing with farmers in groups. And again, I think this is the first opportunity you professionals would have, and will create an opportunity where we can both talk to farmers, present to farmers in a group situation in order to get a clear understanding of any particular topic, maybe to make people aware. You know, you can come along and maybe visit some of the groups, make them aware of some taxation issue, maybe make them aware of some legal issue or something in the market, so that they're ideal opportunities. In my own situation, about 50% of my clients participate in discussion groups, so a lot of them are involved in discussion groups, meeting 5 or 6 times a year. And again, as I said, there's no average farmer, and likewise there's no average group. 3 of them are breeding farms that are involved in the breeding sector, breeding suckler cows. There's one, again, and it probably reflects the situation with regard to the age of farmers. There's only one of the groups specifically set up for young farmers. It's one of the pilot Mockra 3C groups. Works very, very well. You know, I'm not going to dwell on the age issue because I think it was introduced. I'm 28 years in this job. You know, 10, 15, 20 years ago, I could probably easily stand up here and start talking about the age profile. So I'm now moving into the wrong category. So let's not talk about my own group. But we have to recognise that there's a vibrancy. When something new is to be adopted, it's adopted much faster. Younger people will take up the new notion, move ahead much faster. There's a lot less discussion about it. And there is a need for income. You know, if you're in your late 50s, and I think the average age of farmers in 12 was 56, 57, you're at the stage where the mortgage is cleared, the kids are reared, there isn't that great demand for income. Whereas if you're in your, you know, the person is in their early 30s or late 20s, and there's a mortgage and there's children to be provided for, there's a great hunger for cash, and there's a great desire to up the output and move on. There's one finishing group then, which is and a very volatile group in the sense that in the business they're in, they're dependent on buying inputs and buying stock, so they don't breed anything themselves, so very exposed to the market. And again, in relation to financial planning, a much more difficult group to deal with, in that their prices of the raw material coming in, the livestock can vary a lot, the sale price can vary a lot, and likewise very heavily dependent on inputs. And there are two sheep groups. So I think, first of all, if we talk about collaboration and we talk about where we can come together and meet farmers, you know, those 7 groups, that kind of approach is a very efficient way of dealing with farmers, both from our point of view and from your own point of view. And it's amazing the issues that are teased out. A farmer might have a particular issue, maybe worrying about a bit of succession or whatever, and ask the question if there's somebody professional involved in that, and somebody else will say, well, you know, I have a different angle on it, and over the space of a half an hour or an hour, you know, you can get a number of different angles, and somebody will think of something that you haven't thought of yourself, and there's a lot more information and a lot more, the farmer is much better prepared there to make a decision. Public meetings and seminars, we'll obviously have plenty of those when the new CAP reform is announced and the details are announced, and there's a role there for both the financial people and also people in the legal profession there, because there are issues there in relation to how those entitlements are going to be granted, and the value of those and who they fall to in relation to leasing situations. So it looks like it's going to be, we thought the old system was complex, the new one is going to be much more complex. So the public meetings, the seminars, the farm walks, the public events, they're generally about awareness, making people aware of something, and rather than going into very, very great detail. But if somebody is going to you for a consultation, be your accountant or be a solicitor or auctioneer in relation to a land transfer or something that they're going to take on, if they've been made aware of, in general terms, that maybe a group meeting or a public meeting, they're not coming in and you're not starting from scratch with them and spending a half an hour or 3/4 of an hour trying to explain the principles of something. They have picked that up before, so you can hone in directly on what issues apply to them. And I think they are avenues for collaboration. We have been doing it in the past. Maybe we can formalise this more and maybe deal with more people over a shorter period of time. What are the sort of challenges? And a lot of those, will be, there's low profit margin in the dry stock sector. That's a fact of life, and that makes it very difficult. First of all, it makes business planning essential, but it makes it very difficult to make any major financial changes. And I'll go through maybe in one of the further slides there. The biggest challenge there to looking at where you can improve profitability or output is to determine where the farm is at the moment. And we have found that with people looking to have 6-year business plans switching from dry stock to dairy. Some people, it took 12 months to get the financial information off them for the baseline to see, well, what's the farm at today before you move forward for into a dairy enterprise. The age profile of clients, I hit on that earlier on there. 6% of my clients, only 6% are under 35 years of age, so that has its limitations. Low levels of land mobility. I have a slide later on in relation to, and I think Ben Roach referred to it, that the scourge of Irish agriculture is the short-term 11 months rental situation, and quite a high percentage of people are renting land. And one of our approaches there really is in relation, if we can improve the output and efficiency on their own farm, they may well have to not need to rent as much land. And the CAP reforms unknowns, the unknowns that will be clarified maybe in the next 3 to 4 months, will leave people free to make business decisions to either drop land that's non-productive and costing them money. And I think that's something to be welcomed, that we get clarity on that. Insufficient new entrants, it's tied back up to the high age profile there, and it's good to see something in CAP reform there, that we get new entrants and new blood into the business. Because we need to keep output, we need to keep output up. Ireland Incorporated needs more raw material to go through our food sector. That only comes from one place, and the green fields of Ireland. So we need to keep productivity up there. And low uptake of ICT among clients. I'll quickly go through later. We have a couple of software packages we put out onto farms. They're free to farms to use. The biggest difficulty is not necessarily getting the information into it. It's just getting farmers who have ICT skills to go and use it. Sometimes it's a plus. If you sit down and you want to learn to use a computer program and you have specific information of your own to put into it, People find that they learn best that way, rather than you land a computer program into a farm or land a computer in front of somebody and say, well, look, here's an example. You don't know what the end result is going to be like. It could, but at least if they're dealing with their own data and their own information, they'll see what there's the mistake there. So what are we doing? We're looking at particularly, there's two strands, as I say, to the farm output, which is the output. What is the farmer producing to sell? That's the big component of their 60% of their output is the products that they sell. And we're looking at volume, which is basically stocking rate, and our profit monitor will measure kilos of beef produced per hectare. So we want to look at trying with the farmer to increase the volume and also to increase the value of the product they're selling. Quality, to qualify for all the quality bonuses. You know, there are substantial quality bonuses there if farmers meet the spec for beef particularly, and that will help to meet market requirements. In the whole area of genetics, I was only in 2 days ago, we held a beef seminar in Naas, and I was just looking at the impact of genetics on a couple of farms, and the difference between good and very, very good genetics was a sale price per animal of over €400. So 200 animals, you're looking at a huge increase. So the better adoption, you know, there are ways and means and opportunities there to increase the value of the output. And again, something like genetics, it's repeatable. You fix it today, it should be repeatable again next year. Production costs, can they be measured? They can be measured. Are they being measured? In a lot of cases, no. If you can't measure them, you can't compare them, and you can't make any, you cannot act on them. So I think, with regard particularly to the accountancy profession, I think we can liaise together there and try and ensure that as much information is gathered. If dairy farmers, I'm particularly talking now from the livestock sector, if dairy farmers come together as a group, they can list off 5 or 6 items of performance indicators on their farm and discuss it: milk yield, milk quality, milk protein, grass growth. Put a group of dry stock farmers together, cattle farmers together, very, very little measurements common to them all that are being measured. So I think the financial data is particularly important there. Collaboration. You know, I think the financial planning and data collection are linked. We cannot analyse anything, we cannot plan unless we can measure the output, we can measure the financial data on the farm. And as I said earlier on, you know, when you're dealing with data that's 12 months old, it's of no use to try and get any accurate measurement of what's going on the farm. So, you know, you as accountants, you receive data from farmers. We're looking from data off farmers as well. We're looking for data from yourselves. So we should be able to put some system in place where there can be some commonality there. We need this data collected. We need analysis of that. Maybe other places where we as advisors could maybe have a role to play. I'm thinking in relation to farm system changes. Particularly when people are in low income or incomes are low, they're constantly looking at ways to change the farm and what can we do to increase income. And a lot of those may have tax implications in relation to renting some land out or whatever. And you know, there might be a very good notion put forward, but it has seriously negative tax implications. So we need to liaise close together there to see, you know, if there's a proposal, as somebody mentioned earlier on there, a proposal from, it's good from an agricultural point of view, from an ag's point of view, but it might have serious tax implications. That needs to be sussed out early on. For those who are looking in tax planning to have tax bills and be faced with tax bills, and you as accountant are standing in front of the farmer or sitting in front of him and you're produced the projected tax bill and it's to be reduced. You know, maybe you would consider, or maybe you might consider mentioning to the farmer, go back and talk to the advisor, the ag people, and see, okay, if 10 grand needs to be spent, can it be productively spent? Maybe there's a blip in the tax that year and your tax is high, rather than going down the route of maybe purchase of machinery. So we have a tax bill this year, you're going to buy a machine that's going to take 7 or 8 years to fund and to pay back. And maybe the tax bill was just going to be a short-term measure for this season and next season. You know, I'm thinking particularly, we preach to farmers, fertiliser versus machinery. Ireland historically, at this moment in time, we have extremely low soil fertility. Harvest 2020 is very demanding in relation to output and value. And we're not going to be in a position unless we address that measure. So if there's money to be spent and money to be sent maybe to alter the tax bill and it's not, have a look and maybe liaise with us at expenditures that will leave the farmer in a stronger position at the end of the day. and that will increase the overall productivity. You know, the machine, the minute it's bought, is depreciating. Money spent on soil nutrients is appreciating. The farmer will produce more next year, maybe can drop some rented land and improve the overall financial situation. The financial institutions as well, you know, whole area financial planning, we're submitting 6-year business plans there for funding for people who are switching to dairy farming, looking at various, particularly the dry stock sector, and I would have dry stock people, and you know, it's a frightening scenario. Most or practically all of my clients under 35 are going dairying, or want to go dairying, or in the process of switching to dairying. So we're looking at 6-year business plans there for those people, you know, and it will come back to you. If you're working on bad information and bad data and out of date data, we're going to send the wrong, give them the wrong signal. And you know, doing those plans requires. You know, we have a lot of liaison with the financial institutions, but also with farmers' own accountants. So what sort of tools are available to collect this data? And Kevin Connolly was designed this program, and it's a software package there, Excel based, that I'm trying to encourage farmers to use to collect data. For the accountants, rather than they bring in the shoebox piles of data or the bag, whatever description of bag it is, with all the receipts and expenses there. We're looking at this option of maybe trying to get people to collect data and input it here as the expenses come through. So essentially it's a way of tracing cash through the farm. It's a way of recording the income and expenditure in a format that can be analysed instantaneously. You know, you do this 31st of December, if you're like-minded, or the 1st of January, you can email it to somebody and have a financial analysis. So all of your financial data for the previous 12 months is available on the 31st of December. So there are various, you have your regular payments, you have your receipts, your expenses, you can log them in per month, you can generate graphs, cash flows, and this works quite well for the financial institutions, particularly if somebody is looking to do an investment. You're not delayed in waiting to have a whole lot of financial data collected. You have this available at the touch of a button. So this is one of the screenshots of the expenses page. So 17th of April there was machinery running expenses of €60. There was 5,250 livestock sales. So that's already available. So it's an electronic ledger really. And it's very, very easy to go back through that and see if there's been a mistake made. You can track how was the money paid. That, you know, the insurance on the tractor was paid with check 3215. It'll make your life as an accountant or financial advisor a lot easier if you can get the data in that format. And again, that feeds directly into our profit monitor. The same thing with the receipts. You know, on the 17th of October there was a VAT refund, and on the 17th of October also the single farm payment came through. So that's the total. There was 5,727 livestock sales there. So total cash in of 28,779. And here again then, at the end of the day you can look and say, well look, what's the cash movements? When are the positive, when are the negative months? Looking at this, if the farmer has this completed, he can go to if you're going to your financial institution or bank, you can say, well look, I can see the months I need my overdraft. I can measure how much overdraft I need. Now that I can see there's a cash deficit there, significant cash deficit in May and June, maybe I'll divert cattle sales, some sales into May and June to level up the cash flow. So you have a very, very clear, you have the numbers along the bottom there, and you can see, well, what was the actual cash flow? Also we can put in a budget. We have some people on this year 2, year 3, year 4, so you can put in a budget for next year and say, well, by June or July your fertiliser bill shouldn't be much higher than X, Y or Z, or your feed bill. So you can see early on where the problems are beginning to arise, and maybe address those early on. Maybe put in place an application for funds, short-term funds, well in advance of the need. So that can feed into our profit monitor, and at the moment what we're doing for the next couple of weeks, we'll be going through the profit monitors with our groups, and I'll show you next some of the reports. What I put this up screenshot really is what we're after, what we might be require from the accountancy profession there in relation to the headings that costs are recorded in. We get a lot of the costs in, and maybe, you know, it's an accountancy practices in some firms where the feed and fertilizer are lumped together, and you have one cost heading, feed and fertilizer, 80 grand. It's not possible to measure where maybe there's over expenditure or where there's a problem on the farm unless they're separated out, and you can make a comparison from one farm to the other. So, you know, feed and fertilizer together, if there's very little fertilizer spent and fertility is low, maybe that's driving up the need for feed. So we're looking at the variable cost, the input cost. What did it cost to get that level of output? The same with the fixed costs, and as you saw earlier on the very first slide, the huge variability there is in direct costs. They went up 14% in 12 over 11. The fixed costs went up about 5%. So these are that little bit easier to tease through, but we can often see here that we'll say the machinery is gobbling up a lot of the output, so that if we can get the information in this format, it's common, and I know in some of the accountancy firms they're generating the profit manager report directly. So what do we do when we get this profit manager through? The big thing, I suppose, compared to a set of tax accounts or a set of financial accounts, there's generally very little physical measurements of output and performance on the farm. And that's the big plus about the profit manager. It brings together the financial performance and the physical performance. And this is an example of one that will be run through in the next couple of weeks, particularly when we bring this finisher group together and look at how do their farms financially perform in 2012. And we have basically, they're graded into the top, the average, and the bottom third. And then on the right then, we give the farmer their own actual figures. So they can see straight away, people who are in other farms, you know, what are their key performance indicators there of people. You're not comparing cattle farms to dairy farms, you're not comparing suckler farms to finisher farms. These are non-suckler farms, they're finisher farms. So what's the farm size varies a lot. What's the stocking rate? What number of animals are you keeping per hectare? How efficient is that operation? How many kilos of live weight are you producing per livestock unit or per hectare? And indeed, in this particular farm, it was the one where we did the examination of the genetics of the animals slaughtered, and that's where it showed up there was over 400 euro of a sale value of a difference between the lowest genetics and the tops. So you take the size of that operation to up your sale value by 400 euro by breeding. It's pretty impressive. What's the gross output value? So we have the physical performance that won't be seen on the farm accounts, but now we have it there available, so there can be a measurement of how do the finances get to where they are. So we look at gross output value, take away the variable costs, and you can see straight away where your variable costs fall into line versus your peers. The gross margin, essentially that's the money that's available to the farm, that's the return for farming. And again, you're looking at trying to get that as high as possible. Fixed costs, you know, they're very similar to the term. They behave like the term. They're fixed. They're very similar from the bottom to the top. So from that point of view, we can see there that in some cases, if there's high labour charge, the fixed cost can be very large. And then the net profit excluding premia. So the first one, the main one we're looking at there is the gross margin. What's the return on output? So these are the kind of outputs you can get. And then we look at the impact of direct payments on income. So what's the total premia collected? And what's the total premia retained? How much of the premia was retained? And they are some of the 2012 outputs. Moving on to maybe the long-term succession, inheritance and land mobility. I would agree with Ben, as he said, the short-term rent is a scourge on the agricultural business. If we take Laois, Kildare, Dublin, Meath, Louth, which is I know I work in Kildare, but as a management unit, it comprises those 5 counties. 13,000 farmers operated there. I think the figures there for 2010, there was 13,000 farmers. 35% of them rent on average 26 hectares. So a lot of land. So 1 in 3 are renting up to 26 hectares. And if you look at, you know, the price of rented land for the last number of years, significantly eating into profit. And they're mainly annual rental agreements. So we have a need for long-term lease agreements. People can adequately plan and maybe put a bit of investment into the land. And in general, what you're getting to is very poor land, so there's high costs, very low output. Cap reform, again, it's great to see that it's coming close to a conclusion, so people can know, well, can I drop land? Big fear up to now is I'm not going to drop land in case I affect the payments. So hopefully, once there's clarity brought to bear on that and the base years are selected and publicised, the normal practice of farming can go on. Look at the other things. Average farm age for farmers in the farm management survey last year was over 56 years. Nationally, that's out of date, that figure, only 7% less than 35. I think Pat's figure was about 5.6, and my own clients is only 6% under 35. So these are some of our new entrants that we run through courses. And the question I ask, are they going to be farmers or just landowners? Farmers invested a lot of money in education. Their kids are well educated. They're maybe farming, living away from home. They're in good employment. As all of these people you see there are in off-farm employment. A lot of them are living far away from home. Are they going to be farmers? Well, number one, they're not unlikely to turn down the offer of the land if it's offered to them. So that's number one. So the succession will happen. The second thing is, what level of output will they have? If they're taking over a farm and you're trying to farm 80 or 100 miles away from the location of the farm, things have to change. We need to be a little bit more creative as to how they can connect with local farmers and to make sure that the output doesn't drop on that farm. Because at the end of the day, particularly in the dry stock sector, they will need to have an off-farm income. So, the systems need to be put in place to facilitate local arrangements there that are, that comply with all the regulations. But if somebody, is working far away from home, that maybe they can enter into an arrangement with a local farmer to ensure that the land is productively maintained. And as I say, how will they farm? Will it be low output or high output? We try and keep it, hopefully, that there will be a reasonably good level of output there. The last thing we want to see is output to drop, because that starves the food sector of raw material for export. As I say, high output or low output, that's the question to be asked. And I call it distance. They're involved in distance learning at the moment, and we hope that they will be involved in, some of them, distance farming. So we want to make sure that that's as productive as possible. And I say local joint ventures might be an option. So we'll say, just to finish up maybe with this slide, as to where can we see common ground? Somebody asked the question there, what planning do we do with farmers before they go to consider retirement? We'd have a lot of interaction and discussions and plans made with farmers maybe before they would go to retire, looking at various options, send them back to their accountant, to their solicitor, to get an auctioneer to put a valuation on the land, sit down then and look at the farm in relation to that it's not just an asset being transferred, it's a productive unit, it's a business, and the business must continue. What kind of transfers would suit? A complete transfer, partial, a lease, or a gift. There may be various options. I suppose the other thing possibly I think that doesn't happen often enough on farms, parents maybe consider that they pigeonhole people and they say, well, look, that son would like a site, he mightn't want to farm. Maybe to sit them down at the table and say, we're thinking about retiring, what would you be interested in? They might get a surprise in that they might have very little interest in the farm, and maybe somebody will come to the fore who has an interest. The one I would worry about to some extent, we talked about those young people taking over farms, and when you talk to them about what's the income like on the farm you're going to take over? How much money was made last year? Haven't a clue. No idea whatsoever how much was made on the home farm. So if they are to enter into some kind of a settlement with their siblings, to say that, right, they're getting 100 acres, but Mary and Frank and Joe have to be sorted out. If they don't know the income potential of that farm and what it can make, how can they make a valid decision with regard to how much of a settlement they could enter into? And some people are entering into these on a long-term basis. A figure per year maybe will give Joe and Mary and Frank 10 grand a piece, 30 grand a year, and the farm is making 15. That has to be funded from other sources of income. And their spouse or partner may not be impressed in a couple of years when a couple of kids come along and there's no cash on the table, and you're going down once a year to Frank and Joe and Mary and giving them 10 grand each. It's a recipe for disaster. So what can the farm business afford? Forget the financial, if we look at the asset value of the farm, and that was discussed earlier, that's particularly irrelevant to the income earning potential of the farm. So once it's transferred, that's the new show in town then. How can we make money on this? The long-term financial payments by the transferee, I mentioned that, and what impact on farm output, particularly if you have to pay a settlement and pay money across and you're farming at a distance and the output is dropped, then the potential is even lower. Single farm payment, how is it to be treated, gift or leased? Mentioned, I know Kevin mentioned it there, that in some cases it may be forgotten about in the will. The farmer may forget that that's another asset. It's sometimes forgotten. It's a problem then when it comes to making a claim. You have to get people to waive their rights or whatever. So that they may mention in the will. And I suppose I see a role here, maybe when we're explaining the new cap reform to farmers, that we get involved maybe with the legal profession to look at that aspect of it, that's terribly important, because that's a new asset. How will it be treated? If it's mentioned in the wills already, the old single farm payment, will that suffice for the new system? Who will farm the land to draw down the single farm payment? So again, that's a succession inheritance issue. That will very much depend on the mobility of single farm payment or entitlements. Can there be one or two herd numbers? If there's people farming a distance, can they operate to some extent with somebody locally who can maybe partially manage the farm, and there can be a benefit for both parties. So maybe I'll leave it at that, Paul, and possibly went on for too long. So thank you for your attention.
Okay. Thanks, Christy.